Okay, go ahead, Jamie.
Hello. Hi, everyone. Welcome to our discussion on inflation risk. We're very excited to have many of our clients and as well as some of our partners and contacts join us today. Thank you all for taking the time out of your day to be here with us. Our agenda for today's presentation, we're just going to go over a little bit about us. We're going to talk about what is inflation. We'll give a basic definition. Do we have inflation? Take a look at some statistics and measures that indicate that we might. What can you do? We'll provide some generic strategies that investors and folks can take advantage of during this inflationary period. Portfolio impact, and we'll talk about things that are when it comes to your investment portfolio. And then we'll have time for a Q&A at the end. I'm Jamie Edwards. I'm one of the financial advisors at my eCFO. I'll be serving as one of your presenters today. I specialize in the financial planning for the firm, and I serve as a main point of contact for a lot of our clients. We have Mike Munson here. He's one of our co-founders and principals at the firm. Many of you may have had some interaction with Mike. He's the head of tax strategy. He creates our tax models, and he also trades the investment portfolios. He'll be talking specifically about the portfolio, investment portfolios, and the impact of inflation. And we have Juliana Mendez. She is a financial advisor for our team. She heads up real estate strategies for our clients and works with some of you directly as a main point of contact as well. And we have Martin Curiel also here. We don't have a picture of him up, but he's one of the other co-founders and principals of the firm and is the head of investment strategies. He wears many hats, and today he's just going to serve as our AV audiovisual guy today. Now, before we dive in, let's talk a little bit about our firm for our new friends joining us. We're a full service financial advisor. We offer a holistic approach for our clients, and we think through all the different pieces to help improve your financial well-being. We divide this into three main work streams. We think of it as investment strategy, tax strategy, and wealth management. On the investment side, we help clients design, build, and monitor their complex investment portfolios. On the tax strategy piece, we help clients understand and manage tax exposures. And on the wealth management side, we help clients manage, grow, and protect their wealth. The key differentiator for our firm relative to others is that we have a big emphasis on tax knowledge and strategic tax planning, specifically trying to minimize tax implications, maximize your returns, and make sure that you consider all financial decisions through a tax lens. And as we make our way through this presentation, feel free to interrupt us anytime if you have any questions. We have a chat box. We're going to cover the prepared remarks pretty quickly so that at the end we can open it up to a Q&A and have a discussion. So Juliana, will you please start us off and tell us what is inflation?
Sure, thank you, Jamie. And so before diving deeper into the discussion, we wanted to first make sure that we're all kind of on the same page about what inflation is, and we're going to briefly discuss the definition and some examples. So inflation is defined as the decline of purchasing power of a given currency over time. So in its simplest form, inflation is when your money loses its purchasing power. So if you have $5 and that $5 buys you a gallon of milk today, next month, that same $5 might only buy you half a gallon of milk. And so the same dollar isn't worth as much over time because the buying power decreases. So it's a percentage summary statistic that represents the rate at which the cost of goods and services are going up. So that's the main definition of inflation. Next slide. So what causes inflation, right? So when we think about the causes, there are three main causes of inflation. The first one is demand pull. And this is when the demand for goods or services exceeds production capacity. And we see this today with lumber, for example. There's a huge demand for lumber with new homes being built. People may be adding home offices or just doing these side projects at home. And so there isn't enough lumber to go around to meet the demand. And there's also an increase in demand for chips for computers and cars. So it's just this high demand for these different goods or services and not enough production capacity. So these are examples of the demand pull. The next one is cost push, and this is when production costs cause an increase in price. So going back to the same lumber example, the increase in the lumber costs then result in an increase in the home sale price. And so the homes are now more expensive because they're made of lumber. So the price of those products goes up. So the aggregate supply of goods and services decreases because of an increase in production costs. And then the last one is built-in inflation. And this is, when prices rise, wages rise too. So they have to rise in order to maintain these increased living costs. So workers expect their salaries or wages to increase when the prices of goods and services increase to help maintain their cost of living. And we've seen with restaurants, for example, they're having a really hard time finding wait staff, hostesses, chefs, cooks. Some restaurants are even giving their workers incentives or bonuses for coming back to work or signing on to work for their restaurant. So there just isn't enough people to go around to meet the new demand as the pandemic subsides and the economy reopens. So how is inflation determined? Next slide. So the way that inflation is determined is by something called the Consumer Price Index, or the CPI. This is the most common summary statistic that is used to measure inflation. And the CPI is basically a basket of goods that people use on a daily basis. That includes, transportation, healthcare, education, clothing, things like that. So over time, the CPI is used to measure the rate of the inflation increase. Next slide. So typically, when we see inflation show up, the main drivers in the CPI are education costs, like college costs, and then healthcare, and then of course, home prices. So I'll turn it over to Jamie now to talk about whether we have inflation now.
Thanks, Yuli. There are a few ways to measure if we are experiencing inflation. The first graph here is that I want to show you is the money supply, and here it's measuring M2. M2 is something that you may have learned in your economics class in the past. It measures all cash in circulation. These include your checking accounts, your savings accounts, savings deposits, time deposits. Anything that is easily convertible into cash would fall into this basket. Here you see back in July 2016 till about February 2020, the number has been going up steadily, implying that the money supply is going up at a steady rate. But after the pandemic, you see a jump in the rate. Specifically, it's gone up quite rapidly. And this is very important because in the world of economics, it is an indication that perhaps we are seeing some inflationary pressures. Next slide. Velocity is another measure economists use. And velocity means how many times the money in circuit is changing hands in the economy. So a simple example of this would be is if you have $1 and you take a taxi, you pay the taxi driver in cash, and then that cab driver buys a cup of coffee, and then that money from the coffee goes to a restaurant, and the restaurant dollar goes to a retail store, so on and so forth. That's a basic definition or explanation of how velocity takes place. The higher the velocity, the higher the inflation number. But in this case, this measure shows that the velocity really went down after the pandemic. And that makes sense because a lot of people were staying at home. We were all quarantined at that time. So the money really wasn't changing hands as rapidly. And this could indicate that inflation pressures are not as strong if you look at the graph. So thirdly, another way to measure is the 5-year break-even inflation rate. And this is a measure of expected inflation. It's derived from the 5-year Treasury constant maturity securities and a 5-year Treasury inflation index constant. That's kind of a tongue twister. These two measures are used to capture what the investor community expects inflation to be. And you can see that immediately after the pandemic, the expectation of inflation went down significantly. People didn't think that inflation was the big issue at hand. But as the economy has started to move forward and things are opening back up, the rate of increase has spiked. The expectation is that we would have around a 2.6% inflation rate. And again, this is an expectation. It's really It may not be reality, but it's just a measure that people in the investor community do expect inflation to be higher than it's been historically in the past. And lastly, here's a look at another way to think about the Consumer Price Index, or the CPI. This is a 12-month percentage change over a year. You can see that the CPI has increased overall. Now, the energy part of the CPI has been the most pronounced increase in that basket. And although energy is considered volatile, a rise in aggregate demand may be an indicator of inflation. And so we shouldn't overlook this number or ignore it, because perhaps it is a signal that inflation is rather close to us. So now let's talk about what are some generic strategies if inflation is upon us. Yuli, you want to touch on that?
Sure. So what can you do? Some generic or general strategies that folks implement to hedge against inflation. The first one is investing in the stock market. Historically, investing in the stock market has been one of the most effective strategies to hedge against inflation. The rising stock prices are inclusive of the effects of inflation. So when you have inflation, financial assets like stocks tend to go up in value. Another one is gold. Historically, gold has been a good hedge against inflation. There's been some correlations, not perfect correlations, but definitely something that people believe. And then lastly is Bitcoin. It's difficult to predict because it's a new asset class and there's a lot of volatility. Today, it's not behaving like an inflation hedge, but if people believe that it is an inflation hedge, it will become an inflation hedge. So these are some general strategies. Now, when we think about the winners and the losers in an inflationary environment, the winners tend to be borrowers. If you're a borrower, the inflation adjusted value of your debts goes down over time. So if you buy a home and you invest in real estate or purchase a primary residence, you get a mortgage with a fixed interest rate. They're very low right now. Let's say you get one at 2.5 or 3%. And if inflation comes our way and interest rates go up to maybe 5 or 6%, while your debt is worth a lot less, you're paying a fixed rate for 30 years. So borrowing money during an inflationary environment is usually a winning strategy. Tangible assets like property, real estate, rental properties, even used cars can also help you become a winner in an inflationary environment. And then there's inflation bonds, gold, silver, Bitcoin, and growth stocks are all possible asset classes that you can invest in to hedge against inflation. Now, on the other hand, the losers in an inflationary environment tend to be savers. The people that put their money in cash and some bonds, the inflation essentially erodes the value of your holdings. And then we have dividend stockholders who are usually not winners in the inflationary environment. So let's now shift and talk a little bit about the impact on the portfolio. So I'll turn it over to Mike Munson, who's going to walk us through that.
Yeah, so one of the impacts of inflation is that the Fed will raise short-term rates to try to incentivize people to save and to spend less. And that increase in short-term rates helps reduce the future inflation. When there is that increase in the short-term rates, there's sometimes also an increase in long-term rates. When there's an increase in long-term rates, that causes long-term bonds to fall in value. The increase in short-term rates doesn't really have much impact on short-term bonds because there's very little time that the money is earning that difference in rate. But for long-term bonds, it can be a big drop in the price if the rate increases enough. And then there's can be a decrease in stock valuations caused by those increases in rates that right now stock valuations are very high. Price to earnings ratio, price to book, price to cash flow, all the various valuation metrics, especially in the US, are very high. And part of the reason is long-term bond yields are low. An increase in bond yields could cause a decrease in stock valuations. And both of those are short-term effects, that the increase in yields or the decrease in stock valuations causes a short-term decline that's then offset by higher future returns. So over a long enough time period, bonds and stocks both tend to outperform short-term investments. And then the last part's an increase in commodity prices. We talked about gold as a possible hedge. another one, silver or oil. Those are common commodities. Now, there are other types of commodities you can invest in, cattle futures, wheat futures, corn, but those tend to be, there isn't a good way to invest in those, that those tend to have high fees or problems because of storage issues, where it is difficult to invest in something that gives you the return equivalent to the growth in those types of commodity prices. If you're investing in gold or oil or silver, you can get an increase in your investment corresponding to an increase in that price. But if you're investing in the other types of commodities, most of the time you'll get a lower return than the increase in that price. And so here, again, we were talking about increase in short-term yields that's caused by the Federal Reserve, where for many years they've been reducing short-term rates that are currently near zero. And when they increase the rates, there's generally a fear that that's going to cause a big change in many other factors of the economy. But if nothing else changes, then them raising those rates has very little impact on your investments. It's mainly that they'll have higher returns on bank savings and things like that. An increase in long-term bond yields causes the price of the existing bonds or bond funds to fall. And that is then offset by higher returns over the following years. And yet over a 5-year period, it doesn't really matter much how the yields change, because the yield of the bond provides most of the return over the 5-year period. And we had a note here. It says, if you know when long-term rates will increase, sell the bonds before the increase and buy after the increase. And that's what you can do if you know that's going to happen. And of course, we don't know, and our clients don't know actually when the long-term rates will increase. So trying to time long-term bond yields is similar to trying to time when the stock market's going to go up or down. We think it's best to maintain a diversified portfolio and capture the average long-term yield and not try to time when the prices are going to rise and fall on long-term bonds. And as I mentioned, he skipped over that part. Well, sorry, it's fine. Just as I mentioned, the stock multiples now are high because of low bond yields. And again, if you can time it, that's great. That we can sell before the decline and buy after the decline, but we don't think it's reasonable to try to do that. And we have examples here for oil. We buy VDE that holds many stocks that produce oil, ExxonMobil, Chevron, those types of companies. There are other investments we can make that are directly in oil futures, but we found that VDE tends to be more efficient. And then gold and silver, the fees on those are fairly low, and we can capture most of the increase in the commodity price by buying those ETFs. And yet, so this goes over our investment philosophy, that we want to manage the risk exposures first and not be focused on trying to predict which of the different categories will be outperforming in the short term. We want to have good long-term average returns. We do look for tax advantaged investments. For example, on the bonds, we're typically buying municipal bonds and taxable accounts to get tax-free interest. We have a philosophy of hit singles and doubles. That the idea is that the clients make most of their money in their jobs or owning their own business or other types of activities, and that on the investments, we're just trying to get close to the market return. We recommend passive strategies, low-cost ETFs and index funds instead of active strategies. The active strategies, the managers pick individual stocks and try to pick the stock that's going to outperform. That tends to have higher trading costs, always has higher management fees and tends to be less tax efficient because they'll realize capital gains as they sell what positions that did well and buy new positions that have underperformed. And we do make some contrarian tilts favoring asset classes that have recently underperformed when we're expecting a rebound in those.
Okay, Mike, this is Martin. Just wanted to have a quick question on, we talked a little bit about inflation being a risk, possibly. There's, besides the velocity, there's a lot of indications of inflation and what can you do about it? Can you talk to us a little bit about the case for deflation, for inflation not happening, the opposite, I guess, of inflation, and why some experts think that this is just going to be transitory and inflation's not the real problem or the real risk, it's more deflation.
And part of that is that there's a lot of debt in the economy already for consumers, for companies, for the government. There's a lot of debt. And when there's a lot of debt, that tends to cause slower growth. And when growth is slower, inflation tends to stay low or even decline. There's also some demographic arguments that as baby boomers retire, their spending tends to decrease, and that their decreased spending causes a decrease in inflation. And that a lot of the inflation that we've seen recently may have been related to the stimulus programs over the last year, which more than offset the drop in employment, and that increased government checks to individuals is likely to stop occurring, and that drop in individuals receiving income will cause then their spending to revert back to pre-COVID levels, and that again causes the lower inflation we were seeing pre-COVID.
One other question that came through on email is, we're talking about the US inflationary environment, but what about the global environment? Because I guess the US dollar is relative to other currencies. Could you have a situation where you had inflation all over the world? Or is that less likely of a risk?
That's certainly possible, but yeah, each country has their own inflation rate, in part for their own country's monetary policy. There are many countries that try to have their currency stable with the dollar. And so if people in America are having inflation, the people in those countries tend to have inflation also because their currency is tied to the dollar. There are also many that have tried to stimulate their economy by trying to have more inflation by keeping rates very low. And there's a common perception that in the US that rates are really low, they can't go any lower, whereas in other countries, the rates are lower than in the US. In much of Europe and Japan, the rates are negative, and that's not the case in the US.
Okay. Any other questions from the audience? You can send them to me via the Q&A chat, this thing here. I'm gonna stop sharing. So another question that came is the bond funds that we buy for clients. Yeah, if interest rates rise, what's going to be the impact on those?
And it's similar to buying individual bonds. So with the bond funds we buy, most of them will have a basket of short-term bonds, intermediate bonds, and long-term bonds. Sometimes we'll buy a fund that only has short-term, only has long-term, only has medium-term, but most of them have a mix of short, medium, and long. And the impact of a rise in rates on short-term bonds tends to be very small. On long-term bonds, if long-term rates increase, then that causes the value of those to fall, which causes the value of the ETF to fall in the short term. but that's offset by higher yields afterwards. So again, over a 5-10 year period, we'll see similar returns whether or not rates increase.
I got a question from a client that why does the NASDAQ go down when there's talk about inflation? Why is it specifically the technology stocks that seem to be affected? I mean, maybe it's about high valuations, but do you have a perspective on that?
Yeah, that is part of it. The NASDAQ stocks tend to have higher valuations, and that has a bigger impact on them. That it's similar to long-term bonds. Higher valuations mean you need a lot of growth to justify that valuation. And if the inflation picks up and the Fed is going to raise rates and they're going to try and slow down the economy, that slow down the economy hurts the growth, and that hurt in the growth hurts those growth stocks. And then, another part of it is that just some concern that some of those companies will have that the party will stop, that they'll have less enthusiasm, and that they've been driven up by a lot of enthusiasm over the last few years. And if that enthusiasm stops, it could be a significant decline even without an increase in inflation.
So we have a question from a client who's currently staying in Mexico, where they know all too well about inflation and devaluation of the peso. Would you dare put a probability, a likelihood of inflation over the next 6 to 8 months or longer? I don't know if you want to take that.
So I'm sure there will be some, but some areas will have inflation and some will have lower. If we had that graph earlier that showed this big jump in inflation expectations. We had the 5-year Treasury versus 5-year inflation index bond going back a few years, and it was really stable around 1.6%, and then fell to about 0.8%, and then rose to about 2.6%. And on that graph, that looks pretty dramatic. But as we were looking at that, I was thinking a range of 0 to 3% is still fairly low inflation. It doesn't have a big impact on our lives if whatever we're buying goes up 2 or 3% a year. It does compound over time, but it's not like the Mexico inflation they were talking about with 10, 15, 20% type inflation. We just haven't seen that here since the 70s.
Right. Another question: do you think we learned our lesson from the 80s, where inflation got up to what, maybe 11%, something like that? Do you think the Fed would be more prepared to combat it early on?
That's my expectation, that if we start seeing numbers like 10, 15% inflation, that the Fed would raise rates enough to cause us to go back down to the 2 to 3% type levels. And there was too much reluctance to do that in the 70s, but in the early 80s, they did that, and I expect they'd do that again.
All right. Another question that came to my